Thanks everyone for joining us here. It's so hard to believe that we're coming up on the halfway mark for 2021. It seems like not long ago, people were celebrating the fact that 2020 was disappearing in the rearview mirror. But here we are, at least in Southern California, we're still in lockdown. And I think the British people often call it Clampdown. And that reminded me of the best song, or one of the best songs on The Clash's magnum opus of double album, London Calling, which is on the screen right now. I always liked the image of their bass player, Paul Simonon, with so much potential energy, looking like he's about to smash the bass, kind of a la Keith Moon with his drum kit and The Who. But it's interesting, if you look at this picture, it doesn't really look like he's going to be able to break that bass. It just seems like the angle is not right to me. His body seems far too bent over. But anyway, this album cover is kind of iconic. And as we'll see, several slides well into the webcast presentation, as interesting as this album cover is, it wasn't exactly their brainchild, and we'll see that a little further on. I'm going to talk about the economy globally and some of the distortions in the U.S. economy brought on by lockdown and government stimulus. One of the most amazing things, this is a photograph from the Associated Press, which characterizes business in America, which seems to be fairly consistent wherever you go. I've traveled a lot in the last 15 months, and everywhere I go, I hear people in business, large, middle, and small size, saying they can't get employees. And here we see that McDonald's in Pennsylvania was offering a $500 sign-on bonus. You wonder what the terms of that might be. You'd think that maybe if people pocket the $500 and then go to the business down the street and pocket another $500, you wonder how long you have to work there. But there's clearly a shortage of workers because small businesses, medium-sized businesses have to compete still with the U.S. government stimulus checks. And so we all know stories about shortages of labor. Every business that I ask, whether it was in the Southeast America, Western America, Rocky Mountain America, Northeastern America, the message is very much the same. And I think it was today the JOLTS job openings index came out at a new record high of all time. So the story remains the same. Here's the great volatility in predictions of the US economy. We have got every quarter on here. You'll notice the tabular data up in the upper left, that the first quarter GDP showing at 4.2, second quarter estimated to be 9.2, third quarter 6.8, and fourth quarter 4.75. So lots of volatility on GDP quarter by quarter as the effects of stimulus continue to wash over the economy. A lot of people are starting to think about whether stimulus will be extended yet again. Coming, I think, in September, it's supposed to roll off. That's not very far away now. And we'll see if that continues to distort so many of the economic statistics. If we look at nominal GDP, that previous slide was real GDP. Nominal GDP, of course, is higher than real GDP because inflation has started to pick up in virtually all measures. And we see now that nominal GDP is forecast for the year 2021 to be 10.4%. I did not include the slide this time of one of the benchmarks for the 10-year U.S. Treasury yield. Historically has been the average of nominal GDP and the German 10-year Treasury rate. So German 10-year Treasury is at negative 22 basis points. So the forecast based upon nominal GDP and the German 10-year for the U.S. 10-year, if there weren't manipulation by government intervention, it would probably be a little north of 5% in terms of a likely starting place to think about the analysis for where the 10-year Treasury yield might be. So obviously with the 10-year Treasury down at about 1.6 or so, I guess it's even a little lower than that right now. We see it's at 1.53 right now. We see that we're out of context of many of the historical indicators. We'll look at some more a little bit later on in the presentation. Now, of course, what's gotten all of this economic volatility is deficit spending. And we'll just take another look at it. It looks like we're at negative 16.2, so a 16.2% deficit right now on the trailing 12 months as a percentage of GDP. which many commentators have accurately pointed out is one of the highest in U.S. history, basically the same as the World War II debt. And as I've pointed out repeatedly in the past, this understates the deficit because it leaves out about 5% of GDP that is considered to be off budget, even though it recurs every year. So we continue to run over 20% of GDP budget deficit. So as robust as 10.4 nominal GDP forecast is, if we didn't have deficit spending, there would be no economic growth in the United States. If we suddenly took the deficit to zero, we would actually have negative 10% GDP growth almost instantaneously. So we're living for sure on an unusually fueled economy. This, of course, has been aided and abetted by the Fed's balance sheet. We see the explosion of the Fed's balance sheet a year ago, a little over a year ago now, where we went from a Fed ownership of assets on the balance sheet of under 4 trillion to now basically pushing 8 trillion. So it's just about doubled. And that is not quite 20% of GDP, but it's pretty close. So the federal government continues to spend a large amount of money, about 40%, 35% of GDP, and more than half of that 35% of GDP that the government spending represents, more than half continues to be so-called borrowed money. And the forecast on the debtclock.org is that in 4 years, something like 65 to 70% of all government spending is forecast to be borrowed money. I did notice something odd about debt clock. I've talked about the debt clock for many, many years. And one of the things that's on there is total unfunded liabilities. And several months ago, they were showing unfunded liabilities at all levels of the United States to be $163 trillion. And one day, out of nowhere, I checked on it and it was down to $148 trillion. And I don't know why that happened, if they're using a different discount rate or something. If anybody knows the answer to that, I'd be grateful if you would give me an explanation as to why that would have dropped by 15 trillion. Nobody's been able to tell me why now. I'm sure there's some sort of assumptions underneath it. But that kind of a change is pretty radical. Still, at $148 trillion of unfunded liabilities, we're running solidly, basically 6 to 7 times GDP. Now, one thing that has happened with all this flooding of personal disposable income by the federal government, where we now have something like a third of all disposable income is represented by transfer payments in the most recent period from the government. What's happened is loan to deposit ratios have absolutely collapsed because the denominator, the deposits, have gone up so much. So we've actually seeing the lowest commercial bank loan issuance relative deposit rates of the past, basically 50 plus years. And so that has led to a lot of distortions. For example, there's so much money washing around in the system that the overnight reverse repo facilities that are trying to maintain, to manage short-term liquidity in the system have really gotten distorted because there's so much demand there that basically banks are contemplating charging essentially negative interest rates. In other words, paying no interest on deposits and instead charging fees, which would be a backdoor way to having negative interest rates or even the beginnings of a bail-in into the banking system. If your deposits earn you negative money, you're basically subsidizing the bank's profitability, and that's going on right now. Another thing that has been a consequence of all of this disposable income is we have really been helping out the Chinese economy. I did include the slide on here of the various GDPs around the world, but by far the strongest economy, by far on the most recent GDP print is China. And of course, that's because we have been giving money to people, and at some level it's been spent, and a lot of that spending goes to goods that say made in China on them. It also creates a lot of traffic for Amazon, as they are obviously involved in importing goods that consumers buy in the United States from Southeast Asian economies, and also, of course, the Chinese economy. So not surprisingly, as we've stimulated the economy and personal disposable income, we have a very large increase now in our trade deficit. This is plotted inversely, so when the blue line goes up, it means the trade deficit is getting worse. The trade deficit had been stable. It improved quite a lot in the aftermath of the global financial crisis, going from a 6% deficit to about a 2% deficit, but we're climbing back, and this only goes through the fourth quarter of 2020. I'm quite certain that the strong GDP growth of 2021 will be tied into another substantial increase in the trade deficit. Of course, and we'll show this slide in the US dollar section, of course, when the trade balance deteriorates, in particular when it occurs simultaneous with the budget deficit deteriorating, it puts negative pressure on the dollar, and we'll get to the dollar in a few slides further. So this is China's total exports and imports in US dollars, and you'll notice that for years they tracked pretty closely. In fact, it was quite common for the blue line, Chinese import trade, to be higher at times. In fact, as recently as 2017, 2018, the import line, the blue line, was actually higher than the export line, but that's changed thanks to the stimulus in the United States. And now the gap, as we saw pretty much similarly, although that was global on the preceding slide with China, the gap appears to be the widest since, anyway, 1997. So we continue to live off of goods being imported by people, by countries, or United States producing them. Here's the album by The Clash that preceded the London Calling record. This includes the two classics, Tommy Gun and Safe European Home, recorded back-to-back on the A side. Two just sonic boom of rock and roll songs, two of my favorite high-energy songs from the 1970s. And basically, the title of this album, Give Enough Rope, might be a teaser for coming potential inflationary pressure. If you give people enough rope, they can hang themselves. And we'll see in a moment the source image underneath this album cover by the great band The Clash. Joe Strummer passed away at a young age quite a few years ago. He was a tour de force songwriter behind The Clash's success. Here we go with the possibility for inflation. Some of it is deemed by the Federal Reserve officials. They choose to contend that the inflationary surge that's happening in real time year over year in the headline CPI, 4.2, was the most recent data. We're going to get another data point soon. And our model shows that there's some risk of it having a 5 handle on it for headline year over year CPI. Our model actually shows high 4s. But given that inflation on monthly CPI prints has been surprising to the upside above consensus expectations, it would be a change in trend if that didn't happen this go around. So perhaps we will get a 5 handle. This is a survey of consumers concerned about rising prices. And when the black line is going down, their concern about rising prices is increasing. And so clearly, consumer expectations of rising prices have really gone up substantially over the past 12 months, from very little concern of rising prices to the greatest concern in 40 years. And the concern here looks relatively similar to what preceded the tremendous inflation of the Jimmy Carter years. So one of the things that is troubling about this transitory narrative is one of the things that makes inflation grit and not be transitory is if consumers think that buy now or you're going to have to pay more in the future. And there's certainly been some examples of that already as we have dealt with all of the distortions of the pandemic, the clampdown, and the government's response. This is the PCE inflation measure and the core PCE. So the core is the blue line and the red line is the headline. And this is a measure that has not elevated as much as some others, but it's still clearly broken out above the range of the past decade. And we're now running at 3.58 on the headline, and now over 3 for the first time in many, many years. We're above 3 on the core number. In fact, you have to go all the way back to the 90s to get a number on the core that's higher than where we are right now. Here's core CPI. The last was PCE. This is core CPI. And it too has gone to above 3%, or just at 3%, and is at a substantial new high versus recent periods. And it no longer looks like it's going sideways, which had been the look during really the last 10 years. Now we're seeing a breakout. Now, maybe when people talk about base effects, if you look at the blue line a year ago, it was at a local low, and now we're coming off of that year ago local low. And this is the narrative behind transitory. But whenever I get interviewed, people ask me, is inflation going to be transitory? And I say, how does anybody know whether it's going to be transitory or not? One thing arguing for transitory, I will acknowledge, is the base effects from a year ago. But if we look at the month-by-month CPI and PPI numbers, the base effect narrative kind of gets exploded a little bit because we continue to accelerate, not just versus a year ago, but versus 3 and 4 months ago. So there might be more to the inflation story than simply the base effects. And we're going to be seeing that in the months ahead. The big question is, how much resolve will the Fed be able to maintain if we actually get a 5 handle on the headline CPI for a couple of months? My suspicion is the Fed is already feeling some pressure regarding we're not even thinking about making some more hawkish policy moves. That is already started to relax a little bit in recent comments by certain Fed officials. And it's going to be a big question for the markets as we get into the second half of 2021, where that narrative is going to shift. Also, the CPI, as elevated as it is at 4.2 on the headline year over year, it's really should be much higher. The CPI uses a shelter component, which has only shown inflation of a couple of percent year over year, and yet home prices, depending upon what measure you look at, are up well into the double digits on a nationwide basis year over year. If you replaced the shelter approach that the government uses to report the CPI, if you replace that with actual home price changes, the CPI would be 8.5% year over year right now. So one of the things that's unusual is for years, the shelter component was keeping CPI somewhat propped up. Now it's keeping CPI substantially tamped down. So CPI would literally be double if we use home prices instead of the kind of contrived shelter estimate that the government has been using the way they calculate CPI. One of the things to watch also when it comes to social mood and social unrest is things like food prices. When food prices are going up, it really puts a squeeze on lower income people. And we see that the CRB food component year over year is 6% year over year. We also show the food CPI year over year with a 6-month lag. And so we see that that's the blue line area is the CRB food component. It's the commodity foodstuff component. And that leads the food CPI subset by about 6 months. And we can see that the commodity one is up 6%, which would lead us to believe it's possible that the CPI food component could have a few more percent to increase in the several months ahead, putting further upward pressure on CPI. Another measure of inflation is input prices, the old industrial price index, which is now called the PPI. And the PPI, you can see it's not exactly just year-over-year base effects. We can see that the year-over-year number is 6.2, which is very elevated versus recent years. But also we see that the green bars, which are month over month, have been elevated. So it's not just versus those red bars a year ago that were so negative. It's that we are accelerating on a month over month basis in the PPI. Will it continue? Probably not to this extent. But the real question is, how transitory is inflation going to be? And nobody really yet knows the answer. We just know that we're in for some bumpy hills on the roller coaster in a few months ahead. Another thing that argues potentially against transitory is ISM manufacturing inventories are off the charts on the downside. This is an index of inventories reported by manufacturers. And it used to be that 40 was a low number. And that sort of 50 to 55 was a high number, and we're now at the lowest number by far over the past over 20 years. So that's not exactly likely to put downward pressure on prices. What's really been exploding to the upside are certain parts of the economy. Used cars prices have nearly doubled over the past year, which is really incredible. And you can see they've gone absolutely vertical. There is no used car supply virtually anymore. And that's particularly true of trucks. I happen to have an occasion to buy a truck. And not only could I not find a new one, but the price of the used truck was virtually identical to the manufacturer's suggested retail price, the MSRP, on new trucks if they existed. So this is obviously not sustainable, that this index could stay at this elevated level, but clearly this is not a disinflationary chart. Let's talk about the dollar. The dollar has been moving in a range now for years, and the low end of the range has been around 90. It has traveled some distance in the 80s, but it's been hanging out in the lower 90s on the low side, and it has gone above 100 a couple of times in the last few years. We're now at a pretty critical juncture on the dollar. There is clear support down there at the pivot point in the high 89s or mid 89s. That's the black horizontal line. But there's also an uptrend line, the dotted line, that appears to have been broken and retested. So where is this going to go? I don't know in the short term. I'm sort of neutral on the dollar in the short term, have been pretty much for the past couple of months. But I am very negative on the dollar in the long term, as I've talked about at length in past webcasts. And we'll talk about that as factors in asset allocation a little bit later. So this is that kind of infamous slide, I guess, that I've been using for such a while, that shows the red line, which is the twin deficits. That's the trade deficit plus the budget deficit as a percentage of GDP on the left scale. So we're now at over 20% on the twin deficits, more than double what used to be considered a bad level. And we see the black line is the US dollar index, the dollar index, the Dixie. And we can see that there's a heavy correlation between the red line's direction and the ultimate direction of the black line. And it's suggestive of the dollar index going below 70 from a level of 90 today. And that would be something that would have meaningful ramifications for investment portfolio allocation and performance. Home inventories are another part of the economy that are highly distorted. We see that home inventory available for sale compared to recent years. So 2020 was already low inventory before the pandemic, and then it went up a little bit during the pandemic, early days. And then we have home inventory now at the lowest level in any recent year whatsoever. In fact, if we look at it per capita, homes listed for sale per capita, we see that it's about half of what used to be considered a very low level. So home inventory is completely non-existent. And there are parts of the country where the home inventory is less than 1 month at the present sales pace. And there are many secondary cities in the United States where there are multiples of real estate agents per home for sale. In fact, there are some areas where it's 10 times, there are 10 times as many real estate agents as there are homes currently for sale, which doesn't sound good for those agents that don't have any listings. So that's going on. Now, I showed that the Clash's album cover, Give Enough Rope. The Clash were appropriators. I guess all art and all music ultimately is appropriation, but they did it with their album covers. We saw the album cover for Give Enough Rope had this image of these vultures feeding on the carrion of this dead body. They included a horseback rider. I was unable to find the source image for the horseback rider, but here we see this is a postcard, it appears, and it says "End of the Trail." Now, I'll say that's the end of the trail. So here we have equity prices, rest of the world versus the United States, which we've been watching. And this is so elevated. The U.S. has outperformed the rest of the world by so much, particularly since 2005, but really all the way back to the 80s. But if we just go back to 2005, it was fully, or 2008 maybe, it was fully a triple. That the ratio was 0.6 and it went up to 1.8 during 2020, and it's not going up anymore. So non-US stocks have started to perform in line or superior to US stocks, particularly because the US dollar has been gently falling. It's at the lower end of the last several year range. the real key to having equity prices outside of the United States outperform US would surely be this blue line. This blue line would go down if the dollar were to start falling in earnest, which has not happened yet. But yet there are plenty of indications that the dollar should be falling over the medium to long term. I've talked about them at great length in prior webcasts. We'll just reference those. They're up on replay if you're interested in more detail. I turned positive on European stocks, which felt really weird. Just like when I turned positive on financial stocks last summer, it felt weird because I've been negative on them for so long. European stocks, I've been negative on relative to US stocks since the founding of DoubleLine 12 years ago. And it stopped underperforming, and more recently, the blue line is gently declining. It's at the lower end of the last several month range. So European stocks have begun outperforming US stocks. If the dollar breaks down in earnest, which I think ultimately it will, this blue line is almost certainly going to go down. Here, it wasn't this only goes back to 2018, but certainly the outperformance of the US was pretty mighty in the last 15 months or so. Most of that occurred in the first 6 of those 13 months. So we presently own US stocks, and we are presently having strong outperformance in various areas of the non-US stock market. One thing that really hasn't changed, which is kind of surprising when we talk about economies opening up and some states are fully open. We're not open here in Southern California very much to speak of, although things are evolving. We see that the back to work office occupancy in New York and San Francisco, which are on here. San Francisco is blue and New York is red. They're virtually identical. It went down by 80% and it's barely budged. So in spite of all this economic recovery in parts of the economy and some of this inflationary stuff that's happening, we haven't seen any movement to speak of. And this goes through May 26th. So it's pretty up to date in back to work. We're thinking at DoubleLine of having a targeted date, all things being equal, unless there's a setback, that we might start having back to the office begin after the summer on a voluntary basis, at least initially. And I think that's quite common. And also, many people have indicated a desire to have some work from home days, since the virtual technology has proven to be very effective, and in some cases a productivity increaser because it eliminates the need for significant time commuting. All right, I'm going to get my slide deck off to my right, up to my left here, up to speed, and we'll be moving on shortly. All right, so that was back to work. So here we go. Here's, interestingly, the 5 states, speaking of kind of changes due to lockdown, clampdown, and working from home. Top 5 states in 2020 losing people. Interesting, number 1 was New Jersey. So there's some affordability rankings on here, and we see that the states that have had migrations of significance, most of them are at the low affordability rankings. Illinois is above average in terms of affordability, but still has losing people. So percentage, we can just look at the chart here, the tabular data just sort of shows that these have high unemployment rates, which makes sense. People would leave with high unemployment rate. We can see that the business tax climate index is bad in all of these states, with New Jersey being number 50. That's a real feat. To be able to be lower than California in terms of business tax climate index is hard to do. Only New Jersey was able to pull it off. So we just see that these higher tax states, these anti-business states, not surprisingly, now that virtual technology is being proven to be attractive in many ways, these states are losing people. Another thing that changed very radically with the pandemic and hasn't even close to fully normalized is continuing claims for unemployment insurance benefits, where we have different types of them. The one that has really not gone away is PUA, and certainly PEUC has done nothing but really go up. So while we have the traditional regular state benefits, the lighter blue down at the bottom, has largely normalized, it's really a mirage because it's been largely replaced by these other programs. So there could very well be a strong shock to the economy if this yellow shaded area and the red shaded area were to roll off or be allowed to roll off. We would suddenly see some very significant shocks to disposable income that would quite noticeably perhaps reverse some of the trends that we looked at with housing and automobiles. That's the best argument, I think, for transitory, for inflation being transitory, but it also has implications that the economy would go into a significant reversal mode. Job openings, we talked about McDonald's and their $500 sign-up bonus. We also mentioned that JOLTS went to an all-time high today, and here we see more evidence of that. This is not quite as up to date. This is June 1st, but we can see it's pretty much off the charts. So lots of jobs that are open but can't get filled because of the government competing with private enterprise. The strength of the retail investor has also been a distortion due to all of this disposable income from the government. We've never seen anything like this in terms of flows from global investors into both developed market and emerging market equity funds. We're completely off the charts here. So no wonder we've been able to sustain high valuations and high levels, although we haven't really gone to new highs over the past month or so, in spite of the fact that interest rates have been gently declining over the past few months. We're actually at a relatively local low now on the 30-year Treasury bond. We're down to 2.21. The low in 2016, July of 2016, was 2.22. So we broke above the July 2016 low in yields during the pandemic, and then we went back above the July 2016 lows, and now we're hovering right there. So we're kind of an important juncture, I think, for interest rates, and certainly the equity markets have been strongly supported by flows. The Bloomberg Commodity Index has certainly made some progress. Commodities are up very substantially. The scale here is log normal, and it's also very, very big. So this up move since the bottom in 2020 has been extraordinarily powerful. It hasn't come close to reversing the trend, the downtrend from 2008 into 2020. So there could be substantial further movement in commodities. But again, I think only if the dollar gets in gear on the downside, which I think it will, perhaps not in the short term, but the longer term. Might be due for a pullback in commodities given the almost linear nature of this move and the way that it's very substantially reversed the decline of 2017 through 2020. So that's a pretty powerful sign of a bottom, but it may take a pause in the near term. So the dollar is obviously very correlated to commodity prices. When the dollar spot index, the red line goes up, rather goes down because it's plotted. When the red line goes up, it means the dollar is going down because it's plotted inversely. And there's obviously a strong correlation that your eye can readily see that when the dollar index goes down, that's when the red line goes up, the black line commodities, they go up, and that has happened. So here we are at a critical juncture on the dollar, and it's going to be correlated for sure to the movement in commodity prices as we roll forward through the second half of 2021. One thing that has diverged, though, thanks, I believe, to the Fed's activity, is we don't have the same correlation that we've had historically between commodities and interest rates. Interest rates here, we're using the U.S. 10-year, the generic 10-year, and again, the red line is commodities. And what we see here is commodities have gone up to a level that would suggest much higher interest rates than we have right now, but that hasn't been allowed to happen. So this would suggest, simply based on this one variable, that the 10-year Treasury should be a little bit north of 3% right now, and yet we're at half that amount, thanks to quantitative easing and other governmental policies. Lumber, not surprisingly, has exploded to the upside. A lot of demand from home remodeling and building. So we had a 5-fold increase in the price of lumber, and it's settled down. It doesn't look like much because, again, we have a very big scale and it's log normal here. but we have had about a 25% correction off the top in lumber prices. But this looks like it may have peaked out because that's an awfully vertical movement. And this is one of the reasons why I think commodities broadly might be poised to take a little bit of a breather. Gold, we've had a great call on gold. We were positive on it in September of 2018 at below 1,200, and then turned neutral on it around 1,900 or so, and turned slightly positive on gold back when it was in the 1,700 handle. Where it is right now, I don't really have an opinion. I think broadly, with commodities due to take a breather and lumber showing some signs of reversal, it wouldn't really surprise me that much if gold were to not make much more progress, which would certainly not be suggestive of a weaker dollar in the very short term. Ultimately, I think gold will go much higher as the dollar falls and commodities broadly have a further significant leg to the rally that began 15 months ago. Our old friend, the copper-gold ratio, dividing the price of copper by the price of gold, shows a very large divergence that developed in the second part of 2020. We did see 10-year Treasury rates rise. They've risen by 61 basis points since year-end 2020 till today. But the copper-gold ratio sort of says maybe we're supposed to be up above 250 on the 10-year Treasury, kind of corroborating what commodities broadly would have suggested. But again, we're in a price-fixing interest rate market at the present time. Here's a longer-term view of the copper-gold model versus the 10-year Treasury, and it suggests very similar numbers to the preceding chart, which uses a short-term analytic period. We should have probably about a 2.65 10-year Treasury yield. Now, one thing that we've been commenting on in our strategy meetings that we have a few times a week, virtually, of course, at DoubleLine, is for the past few months how little things have changed. This is the corporate bond option-adjusted spread of investment grade, and there was about a minute where you had a buying opportunity before the Fed showed up and started to buy corporate bonds against their mandate of the Federal Reserve Act of 1913, which prescribes such activity, but that hasn't mattered for the past 15 months. What we see now is the lowest option-adjusted spread on investment-grade corporate bonds in 20 years plus. So it doesn't necessarily mean they're going to widen. There was an article today on the Bloomberg Newswire that pension plans in America are virtually fully funded, way better off than they were in recent years, and they haven't been in this good shape since before the global financial crisis wreaked havoc with their funding status. But there might be some demand for corporate bonds out of equities if pension officers decide they want to reduce the volatility of the funding status of their pension plan. They may buy bonds. They may buy corporate bonds because there's a little bit more yield there, and they may buy longer dated bonds in governments and other sectors as well. But that would suggest that the option-adjusted spreads are not about to reverse yet. The observation I make on this slide is there seems to be virtually no room for those spreads to date. That's simply because of duration. The corporate bonds have a long duration. It's not because that there's been credit problems or spreads widening. In fact, as your eye can see on this option-adjusted spread page, there's been modest spread tightening year to date on corporate bonds. So they have outperformed similar duration treasuries on a year-to-date basis, yet the returns are still negative. High-yield bonds, if you can call them that, well, I guess we'll just call them junk bonds. They have the lowest option-adjusted spreads since basically 2007, when you were at the all-time low prior to the global financial crisis. So these option-adjusted spreads show very little room to contract further in really at all. So there's risk here that you might have a setback. If there's an economic setback, you could see junk bond spreads widen. There isn't any evidence of that, but this is all highly dependent upon the decisions of government officials. And so for now, it appears that we're living in a land of very stable spreads and very stable interest rates, really for the past few months here in the US. Just so I'll give you year to date, The 2-year Treasury yield has risen by 3 basis points. The 5-year Treasury yield has risen by 40 basis points, and the 10 and the 30-year have risen by about the same amount, 60 basis points, generating negative returns for high-quality bonds on a year-to-date basis. Let's look at how some of the credit markets have recovered, and I use these prices by letter rating to show what has come all the way back and what hasn't. This is CMBS, non-agency guaranteed CMBS, and we have them by letter rating. So the blue line is AAA, and the high print was 110 on this Barclays CMBS index, and it's at 107 right now. So some of this may be refinancing and stuff that causes the price to not fully recover, because particularly these AAAs can be refinanced as it becomes attractive. But you'll notice that single A, the orange line, is basically all the way back to pre-pandemic. What isn't all the way back really is the green line, and that's BBB CMBS. But you'll notice how much it's recovered. In our webcasts that we did virtually a year ago in June of 2020, and then again reiterating forcefully in September of 2020, the sectors that were likely to perform well were the ones that were not protected by the Fed. And we specifically referenced BBB CMBS, which has had a return on this index basis of basically 50% since those recommendations were made. Let's look at another part of the credit market. These are leveraged loan prices. This is bank loans that are repackaged into CLOs. Well, this is just the bank loans themselves. And we are doing the same thing by letter rating. And here, it's a full recovery across the board. It doesn't matter which one you look at. Even the lowest credit bank loans, the single Bs, the purple line, are at 99.25. And bank loans almost never go over 100 because of their callability. So once you're up towards 100 on bank loans, there's not necessarily a sell signal because you're up at those high prices, but your potential for further profits is virtually non-existent because the prices rarely go over 100. We're in an environment right now that lower tiers of credit, and I don't have the slide in the deck, but CCC high yield bonds are priced almost at par. And historically, when CCCs have been at par, there is no profit potential because of the callability and the credit risk. But when you buy CCC corporate bonds at around par, you almost always experience within a few quarters, you experience double-digit losses. Doesn't mean it has to happen every time, but historically that has been the case. So this is not a good time to be in the lowest tiers of corporate credit because it's fully recovered. And the incremental yield that one gets for BBB corporate bonds versus BB corporate bonds is historically very low. So we're in a period of very high risk at the lower edges of the credit spectrum and historically very low rewards. And we've already banked a lot of outperformance in the past year. And that's been an environment where that risk of lower credit has basis points year to date. So there's been strong outperformance of junk bonds versus investment grade. A lot of it's based upon duration, but a lot of it also is based upon the recovery in prices. Now, I opened with London Calling album cover with that great song Clampdown on that record and some other classics on that epic magnum opus double album. But that album cover was full on appropriation. It was appropriation of none other than the king himself, Elvis Presley. This is Elvis Presley's first album cover. And the font is identical and same colors. And a lot of energy with Elvis here, not like he's going to bash his guitar, but he seems like he's fully into it, probably singing a hound dog or something. The Clash, you got to give them credit for having confidence and guts. They actually had the nerve to have an album cover that appropriated from the king of rock and roll himself. So I got to hand it to them for having that level of confidence in that record that they put out, and it really was that strong. Here's one person asked 3 questions, and they kind of encapsulate a lot of the themes that are in the question boxes. First question, what is the likelihood inflation be the cause of major bear markets in equity and fixed income in 2021? I think there is a possibility. I talked about how transitory may not pan out. And I think there's about a 40% chance that transitory doesn't pan out. So I actually think there will be some merit to the transitory argument. But I don't have a very heavy conviction that way. And if it's wrong, it could lead to major bear markets in obviously parts of fixed income and equities. And I would even give that a 40% probability. Second question, what is the likelihood the Fed loses control over short-term interest rates in 2021? I would put that at very nearly zero. The Fed is in charge of short-term interest rates. They control short-term interest rates. And presently, there's so much money sloshing around that the market forces are also causing zero interest rates at the short end. I talked about that in the deposit basis of banks. Third question, what would cause the market to regard the national debt or the debt to GDP ratio as a major threat to future returns? The dollar going down. That's the linchpin to everything, I believe. And so that's the thing that is the most important. That's why I spend significant effort and time allocation to that issue in these webcasts.